When I retired at 50, my team worried about how I would sleep at night without stressing over the stock market crashing. Well, it's not magic. It's all about buckets. 3 of them to be exact. And no, this isn't Filipino bathroom humor. It's a basic retirement investment strategy that I've tweaked to support my early retirement abroad. So today I'm breaking down my version of the 3-bucket investment strategy, a system that lets your money work hard and gives you peace of mind. Grab a drink, maybe even a spreadsheet, and let's talk about how to make your money last longer than you'll ever need it to. This is Away with Joe. This is the channel where we talk about travel planning, financing your retirement, and living smarter abroad. If you like financial freedom with a side of sunshine, you're in the right place. Make sure to hit that like button, subscribe, and click the bell so you don't miss future episodes. All right, let's build some buckets. Welcome back to the channel. Before we dive into the details, quick disclaimer. I'm not a financial planner, advisor, or certified anything except maybe a coffee addict. So before making any major investment decisions, talk to a qualified financial professional who knows your personal situation. Now that that's out of the way, let's get to the good stuff. What is the 3-bucket strategy? Think of your retirement money like water. You've got a pool to pull from and maybe even a stream or 2 trickling in. Social Security, dividends, whatever. The point is you need to make sure it doesn't dry up before you do. That's where the 3-bucket strategy comes in. Here's the gist of it. Bucket 1 is cash for immediate and short-term needs. Bucket 2, income investments for the midterm, and bucket 3 are growth investments for the long haul. Each bucket plays a role and funds flow down from upstream buckets. And together they protect you from having to sell investments when the market takes a dive. Before we pour any more into these buckets, a quick shout out to the channel sponsor, McCoy's Smokehouse and Saloon in Charlotte, North Carolina. They've got pulled pork that practically melts when you look at it, fried squash that'll make you question every vegetable you've ever eaten, and award-winning smoked wings that will satisfy all your flavor cravings. McCoy's, where calories don't count if you're smiling. Next time you're there, be sure and tell them that you heard about them on Away with Joe. Now, back to those buckets. Bucket number 1, your safety net. Bucket 1 is your short-term cash, enough to cover 18 to 24 months of living expenses depending on your risk tolerance. This money isn't in stocks or crypto. It sits safely in a money market account or high yield savings account, earning more than your regular checking account, but still available when you need it. This is the bucket you are using for your everyday expenses, to pay bills, dine out, buy airline tickets, everything you spend money on day to day. Since this year or two's worth of cash is completely safe inside a money market or high yield savings account, if the market crashes, your bills still get paid. No panic, no selling at a loss, just calm, predictable cash flow. Here's the thing, the average US recession lasts about 10 to 11 months, but market recoveries can take 2 to 3 years to fully rebound. If you're pulling money from your investments during that down time, you're locking in losses instead of waiting for the comeback. That's why bucket 1 stays in cash or a money market account, something safe, liquid, and paying at least some interest. As of recent averages, money market funds have returned around 4 to 5% annually, which is miles better than a regular savings account. Bucket 1 is slow and smooth. Now, on to Bucket 2, your income workhorse. Bucket 2 covers from Bucket 1 through year 6 of your retirement cash flow, and it's invested in a mix of low risk and high dividend assets, the kind of stuff financial nerds call SWAN investments, which stands for sleep well at night. We're talking about high dividend ETFs like SCHD or JEPQ, preferred shares of brands like Coca-Cola, Exxon, Verizon, JP Morgan, etc., and conservative bond funds and REITs or real estate investment trusts, which let you invest in income-producing real estate without having to fix a single toilet. Here's why REITs are great in this bucket. They're legally required to pay out at least 90% of their taxable income to shareholders as dividends. That often means yields of 5 to 8%, sometimes higher, depending on the market. In normal conditions, Bucket 2 might return around 5 to 7% annually, providing steady income while keeping volatility low. It's not meant to double overnight. It's meant to refill Bucket 1 when it runs low, keeping your cash pipeline steady through market dips. And then there's the big one, Bucket 3. This holds the rest of your portfolio and is invested for long-term growth. Think S&P 500 ETFs, NASDAQ ETFs, and other diversified holdings based on your personal risk tolerance and research. Now, a quick note on why I personally prefer ETFs over mutual funds or single stocks. ETFs give you instant diversification, clear and transparent fees, and the flexibility to trade them just like individual stocks. You can buy or sell anytime the market's open. Mutual funds, on the other hand, often come with higher management fees, some hidden costs, and you can only trade them once per day after the market closes. As for your individual stocks, sure, they can be exciting, but they can also add risk and require a lot more babysitting. ETFs keep things simple and cost-effective, which means more of your money stays invested and working for you instead of paying someone else's overhead. Back to the buckets. You won't touch the money in Bucket 3 for many years, which gives it time to recover from market dips and really grow over time. This is what helps ensure your retirement plan outpaces inflation. In short, this bucket builds your future while the others protect and fund your present. While you still don't want to invest in anything too risky here, Bucket 3 should grow at a predictable 7 to 12% with occasional peaks and valleys. Today's episode is brought to you by Champagne Bidet, the only bidet that turns personal hygiene into an otherworldly, effervescent experience. Why settle for ordinary when you could enjoy the sparkling luxury previously reserved for celebrities, royalty, and that one guy who owns a space company? No, not that one, that one. Every spray from a Champagne Bidet is like a celebration. Crisp, bubbly, tastefully over the top. It's the kind of luxury that makes you want to whisper, "I deserve this," every time you use it. Treat yourself to the most refreshing rinse this side of the Riviera. Order yours today at champagnebidet.com. You've polished every other part of your life. Why not polish your posterior? Now the secret sauce. Rebalancing. Every 6 to 12 months, look at your buckets and adjust. If Bucket 1 runs low, refill it from Bucket 2. If Bucket 2 runs low, refill it from Bucket 3. Now, while you're doing your semi-annual checkup, it's also a good time to think about tax-efficient moves. If one of your ETFs or REITs is sitting at a loss, you can sell it and book that loss for tax purposes and then reinvest the money in a similar but not identical fund to help keep your portfolio balanced. That's called tax loss harvesting, and it can offset gains from other investments or even reduce your taxable income. Just make sure to follow the IRS wash sale rule, which says you can't buy back the same investment within 30 days or the loss won't count. There are a few other things to keep in mind when rebalancing. Pull from your tax-advantaged accounts first if you can, so you don't trigger unnecessary capital gains taxes. Consider qualified dividends and holding periods. Sometimes letting an investment age just a bit longer turns ordinary income into lower taxed qualified income. And remember, if you're living abroad, tax treaties and reporting rules might change how your gains are handled. It's not glamorous stuff, but keeping the tax man happy is just as important as keeping your buckets full. One of the biggest emotional shifts in retirement isn't about time or lifestyle, it's about money. For decades, you've been focused on growing your nest egg, watching that balance climb, and feeling good when markets are up. Then, all of a sudden, it flips. Now the goal isn't growth, it's protection, making that money last while you're actually spending it. That change can feel unsettling because every withdrawal looks like you're losing progress, even though this is exactly what you saved for in the first place. The 3-bucket strategy helps smooth that transition. It gives you structure and confidence so you can spend without guilt, knowing your short-term cash is safe and your long-term money is still working behind the scenes. Here's why I love this 3-bucket approach. 1, predictability. You always know where your next few years of income are coming from. 2, flexibility. You can adjust based on your lifestyle or market conditions. 3, peace of mind. Your long-term bucket keeps growing while you're spending from the others. In short, it's a retirement plan that lets you live your life without watching the stock ticker every morning. And honestly, that's worth more than any dividend. So that's it. Ideally, if you employ this strategy, you're never selling growth stocks in a down market, never living paycheck to paycheck, and never panicking when CNBC says the sky is falling. You've built yourself a system that works in both bull and bear markets. All right, that's the 3-bucket investment strategy. Safe, simple, and surprisingly powerful. If you found this helpful, drop a like, subscribe, and share it with someone who still thinks retirement planning means buying lottery tickets. A big thanks to McCoy's Smokehouse and Saloon in Charlotte, North Carolina for all their support. And a shout out to our newest sponsor. After all, you've upgraded your flights, your phone, and your life. Now it's time to consider upgrading your exit strategy at champagnebidet.com. Thanks for watching, and remember, patience makes money, panic loses it. So in the words of my favorite Filipino philosopher, in retirement, the tables have returned. This is Away with Joe, and I'll see you in the next one. Don't forget to subscribe to the channel. And if you enjoyed the video you just watched, check this one out, because I think you'll love it too.